This is a very different market in a way. We've had all yields rising, but the short-term ones are rising faster than the long-term ones. You know what that is? That is a classic stagflationary signal in the market.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for July 10th through July 17th, 2023, while supplies last. This week we feature Buffalo Silver Rounds at $2.99 over spot, Asahi Silver Rounds at $3.05 over spot, and 2023 1-ounce silver maple coins at $4.25 over spot. First, silver Buffalo Rounds are minted in the style of the famous U.S. Buffalo nickel and are made by multiple private mints across the country, but are all 1 ounce of silver, 3/9 fine, and instantly recognizable, making them a great and inexpensive way to quickly stack silver with the flexibility of 1 ounce rounds. Next, the Asahi Refinery continues the legacy of famed private mint Johnson Matthey, which they purchased in 2015, and refined with the same attention to detail, cementing their status as an LBMA certified supplier. Their 1 ounce rounds are 3/9 fine and on sale for just $3.05 over spot. They are also IRA eligible. Next, silver maples were the first silver sovereign coins to be minted at 4/9 fine purity, and the 2023 silver maples remain one of the most in-demand coins today. They come 25 to a tube, 500 to a box, and are available at $4.25 over spot with a minimum order size of 2 tubes. They are also IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Tavi Costa, partner at Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this.
Well, there are a lot of things coming to a head right now that I wanted to discuss. You've been doing fantastic analysis, using a lot of data out there with the markets. One thing I did want to discuss right now is the price of gold. It seems like right now we're kind of in a triple top scenario, and those almost never hold. So can we get your perspective on why you think we're going to break out of this triple top?
I feel very strongly about that. And I think this is absolutely a pivotal moment for the overall industry, because it's what we were waiting for, is a big run up in gold prices that will bring the influx of capital towards the overall industry, which is something we haven't seen in a very long time. And so, this is a technical formation that tends to not hold, but that's not really where I believe this is where the thesis really stands on. I think the overall case for owning gold today has never been, so diversified across all these drivers. It is the production story of most of the majors actually having, not really focused on growth and ultra conservatism. And so you have a secular decline in production across most of them. It's the fact that, we've got a situation where central banks have been accumulating the metal as a way of really owning a neutral asset. And that tends to drive large institutions such as 60/40 portfolios, endowment funds, and so forth that run more in a traditional manner, and likely will be looking for different alternatives for defensive assets. And I think gold will play a role, like is doing for most central banks. Will do the same for those institutions as well. This is something we didn't see in the 70s or in the 1990s, or I should say in the early 2000s. The deglobalization trends that we're seeing, that is causing most of the economies to really reshore their manufacturing plants and so forth. And that's causing a construction boom. It is similar to if you look at construction spending, it looks like the NVIDIA chart. It's going on a vertical line, and that will have, we're going to need stuff and commodities and so forth. So we're seeing likely the beginning of a commodity bull market. And then you look at the CapEx trends of most of the producers in the space and in gold and other parts of the resource industries. you're going to see that we're also at record lows when it comes to in terms of capital spending, of creating new projects, of exploration budgets, and all sorts of things. And so, companies are paying back paying dividends. They're buying back their shares, and so you're not, they're deleveraging. You're not seeing aggressive mode of most of those businesses looking to really grow and expand. Like we saw back in 2011 or 2010 or so forth during that period. And so this is all what's creating. And then finally is the trifecta of macro imbalances, is the debt problem of the 1940s, the inflation of the 70s, and the problem of the valuations of equity markets, like we saw back in the late 20s and late 90s, in the tech bubble and before the Great Depression. So similar to that, policymakers are going to be largely constrained in general, and that will create the case for inflation to run hot than usual, higher than historical standards, and tangible assets will probably do very well. So I believe gold is just, very close to this breakout that we're likely to see.
Now, what do you make of the latest CPI print, 3%? It's the official numbers are, we're seeing definitely lower than expected inflation if you go by the official numbers. Your perspective on that, and why do you think it's going to go back up from here?
Back in December, I put out a chart of the inflation waves of the 70s, and I said, we're going to see a period of deceleration of inflation that a lot of people will be confused and probably think this is the end of the problem, and it's not going to be it. I think the underlying issues that are causing cost of goods and services to be higher is much more structural than people believe. I mean, the wages and salaries growth, especially happening across, folks with a lower income, is something that tends to happen in emerging markets, and it's something that's happening here in the U.S. And it tends to create inflation. Number two, the chronic underinvestments in natural resource companies is something I was talking about in your first question. That hasn't been resolved. And if anything, the Fed tightening monetary conditions have only made access for capital even more difficult. Number three, the reckless amount of fiscal spending today. If you strip out what we're spending or what the U.S. is collecting on taxes, and just look at the spending side, they're spending close to 25% of GDP right now. 25%. We also have a current account deficit, meaning the trade account is also negative. In other words, we are running in the U.S. a twin deficit, and so who is going to finance all this? And the reckless fiscal spending that we're seeing today, that creates inflation over time. And so we're not seeing any changes on that. And the deglobalization trends, I don't think they're going away either. I mean, if anything, they're just continue to develop and continue to show strength. And, it's unfortunate, but that's, we've had a world in the last 30 years or so been very, surprisingly peaceful, despite the fact that there's so much debt in the world. The debt creates wars, or wars may create debt imbalances too. But, I think we're in a position right now where inflation is probably going to be it's probably close to a bottom, and it's very interesting. Everyone looking at the CPI number, which is kind of backward looking in my view. And at the same day, you're seeing oil breaking out. You're seeing other commodities doing very well. You're seeing gold rising. You're seeing silver surging. What does it all mean? This is not a market I would be be betting against inflation here, because I think it's going to be coming back in waves, and we just saw the first one, and we're probably approaching a bottom here of inflation. And once that happens, I think it's going to surprise a lot of people, and it's what drives the tangible asset market in a large way, and why I think commodities will perform so well.
We are seeing an uptick in the last couple days for both precious metals, gold and silver here. I did want to ask you, though, about, you mentioned how we're probably seeing a bottoming of inflation, and we're going to continue to see hard economic times ahead. You've done a lot of research, and you've talked about on this channel the yield curve inversion we're seeing. I wanted to put up this chart you posted with a 2-year and 10-year yield curve inversion. We really haven't seen it this inverted. I believe the chart you have here doesn't go back. I believe it hasn't been this inverted since the 80s. But it's crazy how inverted it is right now. Can you share with our viewers like what that signals for the economy going forward?
Well, and that's just one spread. But if you look across all spreads in the Treasury curve, we're about 90% of the Treasury curve is inverted now. And, a lot of people are looking at the market and thinking, well, if there is a recession or anything of that magnitude, it would hurt gold prices and so forth. And this couldn't be further from the truth, because you're looking at the lens with the lenses of this being another '08, another 2000, or really '08 scenario. 2000 actually played out very different in '08. And why is this so interesting is because the credit market is giving you a signal that yes, inversions are occurring across most spreads in the Treasury curve, but it's not being caused by the long-term yields falling, right? I mean, what we're seeing is virtually all yields across all durations are rising. And so this is a very different market than '08. I mean, '08, 10-year yields are plunging, the Fed raised rates, 10-year yields are plunging. That's what was causing a lot of those inversions. Today, we've had all yields rising, but the short-term ones are rising faster than the long-term ones. Do you know what that is? That is a classic stagflationary, signal in the market from the Treasury market in general. And so, to me, this is another way of seeing how, the next 3 to 5 years or so will, to me, is just a sign where inflation is going to stay longer and higher. We're seeing a problem with supply of treasuries as well, where there's a flood of issuances of those instruments and not enough buyers. And I think that's also going to have an issue with cost of capital being structurally higher. This is very different in '08. I mean, people thinking this is another global financial crisis like we saw back then are going to be surprised to see what going to be the defensive assets that will likely perform well. We can see gold performing well with interest rates rising. I showed many times a chart of 10-year yields and gold rising in the 70s at the same time. Why wouldn't it happen again today when the regime is very similar, although the debt problem today is way worse? We can't really look back in the 40s, because in the 40s, there wasn't really a escape valve like today, meaning gold was pegged to the dollar. We're operating in a gold standard. So a lot of people thinking about, this is going to play out like the 40s. No, we're not in a gold standard. Gold is, it should, a bet against gold, in my view, is basically a bet that the debt problem in the U.S. is going to improve from here. And, seeing the deficits and how the compounding issue of the debt is so alarming, I can't imagine that that's going to be the case. So, those are my thoughts on all this.
Now, when it comes to precious metals, as we mentioned, there has been an uptick in the last couple of days. Do you think we've hit the bottom, and what do you make of this rally we've been seeing?
I do. I think a bottom. I mean, I would say it's going to be sell-offs, obviously, but I think it's we're off to likely to be breaking out from a lot of large resistance that we've seen in the past. For gold is the triple top. The triple top, created a historical resistance. We've had a sell-off, that lasted about 2 months or so. Absolutely normal. The sell-off wasn't as severe as a double top, like we saw back in when Russia invaded Ukraine, and we had gold surge and then hit a prior high, and then it completely fell apart for the following months. This is very different. And so today we hit another time the same level, which formed the triple top. We sold off, and and then we have headlines on Bloomberg, coming out saying that gold is unlikely to be a haven asset, and you can see the skepticism on the wall, of towards the metal. And then you look at silver prices. There is a massive, decade-long resistance on silver, in a downward trend that we've had over the, call it, 12 years or so. And every time we've hit this resistance, a major sell-off happened. Is this going to be the case again today? I mean, we hit this resistance so many times. I feel very strongly this is the end of it. We're probably going to be breaking out along with gold prices. It would make sense if those two coincide. And when we break out from that, it's like holding a volleyball in under the water. I mean, it's just silver is likely to be pressure massively to the upside, and that's why I still think that it's none of us own enough of it. And to me is one of the most exciting parts of the commodity market. And I think we're going to be entering a new gold cycle, like we saw in the early 2000s, like we saw in the 70s, but potentially the most important gold cycle we've seen in history. And this is given the fact that in the 70s and the early 2000s, we didn't have a trifecta of macro imbalances, and today we do. And that's going to allow gold, and we were not operating in a gold standard today, which is different than the 40s. And so likely, this is going to be just the beginning where metal prices will take off from here, and I think will create influx for the precious metals industry, and silver will outperform gold because it's what happens during gold cycles. And so I'm really excited about what's ahead.
Now, some other commodities we could look at, for example, oil often rises, or that causes a lot of inflation when we see oil rise. You've recently stated that we've, had a very large pullback in oil, and given current economic conditions, you think this is we're nearing the bottom here. Could you expand on that?
Yes, I think the risk reward is skewed to the upside, meaning, I think for an investor who's always should be thinking about the risk of investing in something versus the reward of it, this is as attractive as it gets. I mean, we've had a 45% decline in oil prices recently. And at the same time, when you look at the underlying issues in the energy space with still very, very constrained supply, operating rigs is still declining. You got you look at production is still below pre-pandemic levels. And so now how do we justify going a lot lower? Now, a lot of people saying, well, it could be a demand shock. We already saw a 50% decline right now, 45 or so. It's already reflected in the price, essentially, in my opinion. And so, if you go back to the 70s, not the 2008 era, again, that's a wrong, in my opinion, very wrong period to be comparing to today. At that time, energy companies are spending money right and left. CapEx in aggregate was at record levels. Today, we're at opposite stage, and oil prices, even during a recession in 73, 74, in a stagflationary environment, oil prices actually were rising, and that's because supply becomes more relevant than demand. At some point, demand will play an impact and fall and create a downward pressure on the prices. But we already saw that in oil. So I'm excited. I think oil can change the narrative at a time when the Fed is deciding to supposedly pause rates. And we can see something different. We can see actually, inflation regaining some momentum. And if that's the case, Fed may have to stay with rates higher for longer. What does it mean for equity markets? You have to really extrapolate that thesis over time. And I don't think it's positive, but it's certainly very positive for tangible assets, because we know for a fact that the Fed and the government cannot sustain, raising rates as much as they have recently. This is, the cost of debt here in the U.S. is surging. The interest payment is absolutely in an upward trend, and it's not what we need to have, what we can see here in this environment. So, again, I think oil is an attractive bet. I would make it at a smaller allocation because it's more it's certainly riskier than gold. Gold is a defensive asset. It should perform well in a bad environment, different in 08. And so, oil, I think if we could see oil performing well, but there's definitely more volatility aligned with the commodities. So, I'm still excited about oil, but I wasn't as excited, I would say, 6 months ago or so, and now I'm definitely in the camp that I think we should own some oil. Yeah.
And when it comes to other commodities that don't necessarily do well in an economic downturn, if we look at at platinum and copper right now, your perspective on those, because some people, are very bullish on those, but other people say, if we're going to an economic downturn, those will not perform well.
Well, I think there's a possibility of that. I mean, there are times when resources perform well, despite the fact that you've seen a recession. And it is important to see that you have a dislocation in the market, right? I mean, equity markets are surging, but then you have commodities that are cyclical already had a pullback, a significant one, oil being an example, copper being another example, and so are they already reflecting that concern that people are, stating? And I think there's a large, you can't never answer that question fully, but to a certain degree, I think that's really, I'm very bullish on Brazil for my views in tangible assets, commodities, and so forth. I'm not sure, there's that much of a risk. Yeah, I mean, if things, I feel strongly developed economies are in a choice between an inflationary era or, a Great Depression era. And, it is really that, binary, because you have, either they're going to allow inflation to run hotter and over time, and then tangible assets to run hot, and at some point reestablish some sort of financial repression, or they're going to fight inflation tooth and nail and, create a huge problem, which is, a total, the economy will halt itself, and, globally speaking, and, and then in that world, I don't think you want to own anything. So I don't think that we're going to go that route. I think probabilities, they're not zero in each side. And, I think the probability of inflation is way higher. I would weight that as a potential outcome here in a much larger way. And why I think commodities will outperform equities over time. Emerging markets like Brazil, commodity-led economies, will outperform developed markets, especially the ones that have imported resources, net importers of resources. And so I'm excited about all those, different ways to capitalize on those trends.
You mentioned commodities outperforming the equities. Your analysis of yield curve inversion, if we could get back to that, the correlation that you found is when the percentage of yield curve inversions went above 70%. Then for the next couple of years, correct me if I'm wrong, gold then outperformed the stock market. Can you expand on that and how that seemed to be really one of the, if not the only, reliable correlation you could find?
I created this indicator, the percentage of yield curve inversions back in end of 2018, beginning of 2019. And this is because we're seeing a few instances of spreads inverting, and I want to understand more comprehensively, how many of those are inverted relative to the overall potential spreads that we have in the Treasury curve, and then look back in history. And what I found is that every time you go above the 70% handle, we saw a hard landing in the economy. But a hard landing in the economy, meaning a recession, doesn't necessarily mean equity markets decline. Now, we've had, let's say, the S&L crisis, where markets are cheap at that time, and markets only fell by 20%, and here we are back already in a bottom. And we had other times when equity markets got absolutely destroyed, like 2008, like early 2000s, early 80s, 70s. And so my idea was, okay, well, calling a recession is not really a effective way of running money. So I really need to understand what's the best way to position a portfolio. And we've had times when gold performed well and gold didn't perform as well. So 2008 was a classic example where, there was a decline in gold prices as this whole environment played out. But gold outperformed equities. That's an important aspect. The gold to S&P 500 ratio increased not because gold was rising, but because the S&P 500 was absolutely getting murdered at that time. In early 2000s, we saw both legs of that trade working. Gold was rising, S&P was falling. And so, there's all sorts of instances. And I looked at Treasury markets. Treasury markets work really well as a protective asset until you get to the inflationary eras like the 70s. And so, kind of what we saw here recently. And so, all those things are kind of playing a role into how to really understand positioning when you have the 70% handle. But my empirical analysis shows that by far the best thing to own is the gold to S&P 500 ratio, because you just don't know which one is going to work better. But the ratio itself tends to perform very well for the next 2 years after you get a 70% handle. And so we had that in November. The ratio was working really well. Recently, we had a pullback, which is normal, by the way. We've had other pullbacks in the past. And around July, in my calculation of average performances, is sort of when you start seeing that really take off again, which is interesting that we're seeing that now. I don't know if this is going to play out exactly time-wise. The seasonality of all this is going to be exactly the same, but it's, potentially there is a case there too. But what's more interesting is the fact that, a stagflationary environment like the 73, 74, or the early 2000s, where we had a very, very speculative environment of really excessive valuations and so forth. You look back on those two periods, the return, the average return of this ratio of owning gold and selling S&P 500 actually was, way better than the historical average of the other time. I do think that they have, some similarities to today. I mean, the tech bubble, the euphoria towards AI, and you're seeing mega cap companies lead the way to the upside, and none of the other sectors and other companies are really following along. Fundamentals are not following the same line with prices, and it's hard to justify valuations. And then you have structurally inflationary environment like we saw back in the 70s, with the lack of capex among natural resources. You're seeing a more deglobalized environment and so forth. So I can go on and on. And so I think, the importance of that chart and that research is that, owning gold and selling stocks right now is probably the most prudent way to kind of go through the next 2 years of this, what I think is a huge credit imbalance that we're seeing, that will likely at some point create a hard landing. And given valuations, I wouldn't be surprised if we have a crash in the markets, but actually drives gold prices higher, given the fact that it's going to play as an inflationary era type of defensive asset. And so, I think it's an exciting time to be doing that exact, portfolio positioning.
Definitely an exciting time here, Tavi. If our viewers are interested in learning more about your work, where can they find you?
They can find me on Twitter at Tavi Costa, or at the website Crescat.net. They can also find letters and other types of research that we put out about what we do.
I'll put those in the description of this video here, and I really encourage people to check those out. Tavi, once again, thank you so much for your time, and God bless.
Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.